Accounting equation and Excel, short-term investment sale, recording the related realized gain. Get ready and some coffee because we're about to learn the accounting foundation, the accounting equation using Excel. Here we are in Excel. If you don't have access to this workbook, that's okay because we basically built this from a blank worksheet but started in a prior presentation. So if you want to build this entire worksheet from a blank sheet, you may want to begin back there or just construct your own worksheet as we go, or possibly just follow along with good old paper and pencil. If you do have access to this workbook though, 4 tabs down below, example, month. First, a word from our sponsor. Yeah, actually we're sponsoring ourselves on this one because apparently the merchandisers, they don't want to be seen with us. But that's okay, whatever. Because our merchandise is better than their stupid stuff anyways. Like our Trust Me, I'm an Accountant product line. Yeah, it's paramount that you let people know that you're an accountant. Because apparently we're among the only ones equipped with the number crunching skills to answer society's current deep, complex, and nuanced questions. If you would like a commercial-free experience, consider subscribing to our website at accountinginstruction.com or accountinginstruction.thinkific.com. Month 1, practice. Month 2, example. In essence, the answer key. Month 1 is the prior month of operations. We're currently working in month 2. The practice tab having pre-formatted cells so you could practice the practice problem with less Excel formatting. Month 2, the current month of operation, used to be called the blank tab, where we started with a blank worksheet, but are basically continuing on with a template at this time, noting that we will be adding to that template as needed as we go, practicing our Excel tools and formatting as we do so. Let's go to the example tab to get an idea of what we will be doing this time. We're in the second month of operations. Last time we recorded a transaction that is a little bit more unusual than the normal monthly types of transactions, that being the loan payments. Although if it's an installment loan, then it becomes somewhat of a systematic type of process. This time, we're going to do another transaction that we don't see all the time. Therefore, we can't really set up a general routine that will be automated for this type of transaction. And that's the kind of transaction that kind of throws a wrench into the system that we have to make sure that when we see it come through, that we can deal with it somehow. And that's going to be dealing with the short-term investments. Now, I want to have a quick word with investments in general. We've touched on this before, but I want to keep on reiterating the concept of investments and when we would use them, because they often get mixed up in people's understanding of investments. Now, first, there's multiple different reasons why we might use the word investment. When I think of investments from a personal side, I think of investments in stocks and bonds, for example, and trying to generate revenue on those investments. When you look at the business side of things for the accounting equation, we also used the term investment to invest in basically all assets other than cash, right? Even the cash was a type of investment because you could say it's an investment from the owner into the business. So in essence, you can think of in one light, all of the assets that the business has are basically an investment, in particular, the purchase of the property, plant, and equipment and the inventory, because those are the long-lived assets that we need to buy in order to help generate revenue in the future. The revenue, of course, being the return on the investments. So, and then we can use investments more strictly when people think about investment tools or types of investments. They're usually restricting to stocks and bonds, for example, market-based kind of investments. And that's what we're talking about this time. Now, the thing with market investments that I want to make clear as well is that most businesses are not financial businesses, right? If you're in a financial business, your company, your business books are set up in order to generate revenue in the form of dividends and interest. Then you're going to have, normal process stocks and bonds on your balance sheet. But most businesses are not, right? Like Apple is there to make iPhones. We're here to make basically guitars and do guitar lessons. CPA firms, bookkeeping firms, law firms, they do services. They're not in the business of investing in stocks and bonds. So normally, in that case, you're not going to have stocks and bonds on the books of the business per se, or when you do, it's going to be for a specific purpose. In other words, if this business we set up for the objective or aim of generating revenue through the sale of guitars and guitar lessons, then when I get cash will hopefully accumulate, because what's going to happen is I'm going to sell guitars and I'm going to generate cash. And if I want to put that cash somewhere else to make more money, then I would usually want to distribute it to the owners if it's a sole proprietorship in the form of a dividend, if it's a corporation, if it's a sole proprietorship in the form of a draw, if it's a corporation in the form of a dividend, so that then the owner can take the money and invest it in stocks and bonds, right? Because their portfolio has the objective of generating revenue just from stocks and bonds, basically. Whereas the investments in the business here, the assets here, are to generate revenue through the business operations, which happen to be selling guitars in our case. However, you might have situations where you want the money in the business, you do not want to distribute it back to the owners, which would be like a dividend or in the form of a sole proprietorship with a draw, because you want to buy something in the future, possibly. So you're stacking up your money so that you can buy a new office building, possibly. If that's the case, then we might want to park that money somewhere other than the checking account, and we would have short-term investments in that case, right? Now, the taxes also mess things up a lot. So if you had a corporate structure and you were taxed both on the corporate side and on the individual side when you receive the dividend, you get messy situations where you might not want to give yourself a dividend because it's going to result in more taxes, and you might end up thinking, well, it would be better if I can just invest the money within the business and so on. But taxes are messy. That messes everything up. For a sole proprietorship, flow through entities and whatnot, that's the general idea, right? If I get money and I'm not going to put it back in the business, I should give it to the owner, who then invests it, unless I want to keep it under the umbrella of the business with a future eye towards using it for revenue generation, purchasing something like office buildings or furniture and equipment or inventory in the future. One other thing I want to point out is that you might then say, well, what about the bookkeeping for my personal investments? How do I do that? You could use the same system, an accounting system with a double entry accounting system, and use tools like a QuickBooks or a Xero, for example, in that case, in which case you basically have your personal finances, which are a little bit tricky because the objective of your personal finances are not strictly revenue generation. It's to live well, right? So it's a little bit, that's why we separate them between business and personal. But you still have the goal of revenue generation and spending and budgeting and whatnot. And the accounting equation system still works beautifully. And in that case, then of course, your assets will include the investments in, say, stocks and bonds. One thing you want to keep in mind there is that the accounting system, whether you use Excel, whether you use QuickBooks or Xero, is not designed to check day-to-day transactions in each stock and bond account. You want to do that in other software, or possibly with the platform that you're investing in, like the Vanguard or the E-Trade or their bank or whatever you're investing in, can track that information. What you want in your accounting system is to summarize that information. So you probably don't want, if you invest in individual stocks and individual bonds, every single list of individual stock and bond that you invest in, because that's going to get quite tedious to update, but rather summarize, possibly in the form of short-term and long-term investments, possibly in the case of an individual investor, the investments under like an umbrella, like a 401k plan or an IRA, which you can't really get to, therefore long-term, versus short-term, those investments that are outside of that umbrella, which you can manage and get to if needed. So those, we have whole other courses on QuickBooks and whatnot for individual investments if you want to look at that. It's also an issue, one more thing, that like all of the accounting softwares are like online right now, and you have to pay per subscription, unlike it used to be where you download the software to your desktop and then you can make as many company files as you want. So that means that if you don't want to pay for two accounting systems, you might want to do the personal bookkeeping in the same account as your business bookkeeping, which you might be able to do if you're sole proprietorship, although many people wouldn't recommend it, but it's possible, right? And you might use the class tracking feature is one of the things that you could do to break that out. We've got other courses and presentations on that if you're interested. All right, but here we're gonna say that we have this investment in stocks and bonds that we put on the books a while back. It's at $12,000. We're gonna imagine that either it came due automatically, like it's a bond, and now it came due, and the bond is now going into our checking account, which we would see with the bank feeds, or possibly we're gonna take the money out manually out of the stocks and bonds account because we need to use it in order to buy furniture and equipment or property, plants and equipment or inventory. So when this hits our checking account, like if it happened automatically, it's going to we'll see it in the bank feeds, but it'll be unusual, right? So if I was to say, this is what it might look like if I said two, we're going to say cash for short-term investment value deposited to checking. So let's say it was a bond and it came due, and then we said automatically just put it into our account. Well, if it came due and it was value and the value was $12,250 at the point in time it came due, then we would see in our checking account $12,250 as a deposit. And that's going to be unusual because this doesn't happen on a daily basis, as does revenue sales, for example. So notice one thing we have to keep careful about that we've talked about in the prior month presentations is that usually when a deposit hits the checking account, it's from a customer, and therefore at some point in time is going to affect revenue, right? Revenue is going to be impacted. And we might have a system where we're trying to automate the system, so every time we get a deposit, we let it go through the bank feeds and we record it as revenue because all the deposits are generally from customers, right? That might be one system you might use in a bookkeeping system depending on the circumstances. So then you would have to distinguish the deposits that aren't from customers to make sure that you don't record the entire thing as revenue. Otherwise, you will overstate revenue, and if you're in the United States, you'll be paying taxes on something that shouldn't be paying taxes on. Those deposits, as we saw before, might come from the owner in the form of an owner investment. That doesn't happen all the time. Might come from a loan from money that you got from the bank in order to purchase property, plants, and equipment. These are usually startup type transactions. And now we see that we could have this deposit from an investment that became due that then goes into our checking account. It's not from a customer. So we have to make sure we have a system to recognize that deposit as not from a customer, not recorded as revenue. So where does it come from? Well, we're going to go, okay, where did it come from? We're going to say, well, it came from the investment. Here's the short-term investment. It was on the books at $12,000. So I can't take it off the books at $12,250. Why is it $12,250? Because we earned revenue on it in the form of possibly interest or dividends. That's why we put it in the investment rather than just in the checking account where we wouldn't have got any money for it. So we can think about logically, what does this mean? Well, we have to decrease the short-term investment. It is now gone. It's not on the books in the form of stocks and bonds anymore. And then we're going to have cash. Cash is going up because it went from the short-term investment to our bank, but not for the $12,000, rather for the $12,250. There's a difference of $250. Where's the difference of $250 going to go? That's going to be going to a realized gain at this point in time. Now, as I get into that, notice that opens up another kind of can of worms, another question with regards to investments, which often can confuse people. And I'm not going to get into the generally accepted accounting principles too much for normal reporting, although I'll talk about the concepts a bit here. So the idea would be here, if I have my short-term investments, I might break out my short-term investments, particularly if it was for like my individual books, in the format of whom I'm investing with. Who am I investing? Is it E-Trade, Vanguard, my bank, and so on? And then have an account per those or per type of account. Is it an IRA or something under a 401k plan? Or is it a not under a 401k plan or an IRA? So I have more easy access to it without being penalized if I'm not in retirement age. So then what's going to happen over time is the account's going to change values because the stock's going to change value if you invested in stocks and bonds. So then the question is, well, should I adjust my short-term investment, which was on the books for $12,000, if it went up to like $12,500, then I had an increase in the value of the stock, but I haven't realized it because the stock could go down the next day. So normally I don't do that, right? Normally with like furniture and equipment, if you buy a building or if you buy like a forklift, for example, the forklift is going to go down in value over time, almost for sure. It's not going to generally go up in value, and that's why what we do is we usually estimate the value it's going to go down by, and we basically depreciate it over time. Now the kink on the fixed assets is usually real estate. Real estate could go up. So if you buy a building, basically because of the land that it's on, it might go up in value. And then you run into the same type of problem. It's like, okay, should I record it as the increase in value goes up, even though I haven't realized it, I haven't cashed it in? In the United States, typically for buildings, we don't, but you could see the argument why you might. Now, in short-term investments, especially if you're in the stock market investing in publicly traded bonds and stocks that are on the stock exchange, there's a bigger argument to say I should be able to adjust my stocks to the market value. Why? Because they're being actively traded, and stocks are kind of like currency in that all of them have the same value. So if I can see stocks are currently trading at some value, then that's the same value of the stocks that I have, and therefore I have a huge benchmark to do that. Whereas in a building, I can't do that. All buildings are unique, and to sell any building is a big process, and therefore it's difficult to give an accurate value at any time. So that's an argument to say, well, yeah, I should be recording the short-term investments. So what if I did that? What if I said, well, I'm going to increase this by $12,500 even though I hadn't yet sold it? Then where would the other side go? Well, I could put it to revenue, but again, I would be recording revenue that hasn't been earned. So the other option is you could record the other side into a contra account in equity and call it unearned revenue. And that's kind of the in-between step or the in-between argument, saying, hey, look, I'm going to record my assets at the current value, but I'm going to show it in the equity section, not on the income statement, to show the other side, to show that that's an unrealized gain. Now, that's more difficult to do. So from a practical standpoint, usually what we're going to do is we're going to record it as income, right? We'll record it as unearned income, right? Short-term investment goes up. I record the other side to unearned income on the income statement. That would be the easy thing to do. And if I have a loss, I would decrease it and record the other side to short-term losses. The other thing you could keep in mind when you do that is you could also say, well, what if I want to record my account at cost and then make another account next to it, which is kind of like a contra account or a related account, which will show the unrealized gains and losses, similar to what we do with furniture and equipment. So instead of hitting this account directly with the increases and decreases, maybe I make another account and show the increases and decreases of unrealized gain in that account. So I could say, hey, look, this is what I actually bought it for, and here are the related increases and decreases. And like with the furniture and equipment, the difference or adding, if it's an increase or a decrease, will be the actual value of that particular stock. All right, those are the things just to kind of keep in mind here, but we're just going to sell it in our case. So we sold it. We had $250 that was realized gain. So I have to put that over here on gains somewhere. Now, the other issue over on the income statement is that, look, that gain has been realized. My revenue is usually at the top of the income statement, the first couple of accounts. So you would think that I would put realized gains like here. But I'm not in the business of selling stocks and bonds, and therefore I might put it at the end of the income statement because I'm going to put it in other income. And that means that it's going to be on the bottom of the income statement. That's going to give me a longer income statement, but it'll give me operating income, which will be the first part of the income statement. And then the last bit will be over here saying, hey, here's the other stuff that had to do with financing and had to do with gains and losses on stocks, which is not normally part of my business. The same could happen with the interest. I'm going to put the interest over here as well, and imagine that it's going to be something that's a little bit that we might put at the end of the income statement, not as an operating expense, because it's a financing expense. Although sometimes you might put that in the normal operations as well. We'll see that more when we make the financial statements. But if you were to create an account in QuickBooks, your option is going to be, do I make it an income type of account, which will put it at the top of the income statement, or do I make it an other income account, which will put it at the bottom of the income statement in its own category? I would put it at the bottom, other income. Also, you could have a loss, in which case you would say, well, should I put it in other expenses? Because it could be other expenses at the bottom. Now, you have a couple options in QuickBooks on that. Like you could say, I'm just going to put it in other income, and if it becomes a loss, it's going to be a negative. It'll show up as a negative other income, instead of having other income and other expenses for gains and losses, which will make two accounts. I don't want two accounts typically. I just want one account that's going to go flip. It's going to be negative or positive. So just a couple things to keep in mind. But in any case, we're going to put our cursor on AN here and then right click and insert. That'll put a column to the left of it. And I'm going to say it's going to be gains on sale of, and I'm just going to call it INV for investment, INV. And then we'll make it a little larger so we can see it. And then I forgot what line I'm on here. What line are we on? Right here. Boom. So this is going to be equal to, and I'm going to say it's going to be 12,250, let's say, minus the original investment, which is that 12,000. And that gives us the 250. So it's going to be an increase of 250, increasing net income, therefore increasing equity. Let's put zeros across the board. Zeros across the board. Zeros across the board. Not there. And then we'll put an underline. I'm just going to select the whole thing again. It's the faster way. And then home tab, underline. And then I'll get rid of the underline. This time I'll do it this way. I'll select these two, hold down Control, and then underline them at the same time. That's even faster. All right, and then let's pull down the balance, see if we're still in balance. So the only change here was 250 because cash went up, but the other asset went down, investments, by 12,000. Difference 250, nothing happened to liabilities, and the equity went up for the other income of 250. So the balance then, let's pull the balance down, equals the sum of these two. And then I'm just going to copy that, and I'm going to paste it all the way across once again, pasting it, just the formulas though. And then there we have that. Now this time I need to copy them down. So I'm going to copy this down and then copy this down. Oh no, what did that do? Why did it do that? Okay. All right, and so there we have it. So that looks good. So now let's pull down our balances and see if our balances are still in balance. So there's that, and the liabilities 70, and then that red should turn green. Boom, let's put an underline under these, home tab, font group, underline. So cash went up by the 12,250. We brought the investment, oh, here it is, went down to 0. I was looking at that 12,000, like, wait a second. Why did I use 12,000 for both numbers? And then the income. Now notice on the income statement over here, This is the current activity for the income statement. Boom, 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 boom. If I select it, I could see the total down here at the 346. And then notice I still have the prior balances up top. So if I hold down Control and select these, then the total sum of both of those is 7,082. That's why I kind of did it that way, right? So I can see in my worksheet this way, similar to how you would see in a QuickBooks report, in which case you can make the income statement for a month or 2 months or so on. So we're currently working on the current month. So the income for the current month would just be this, but I can add it to the accounts for the prior month and get the net income for the full amount. So I'm trying to simulate in this more what I might call like a two-dimensional system, what would happen in what we're able to do in a three-dimensional, what I would compare to a three-dimensional like database program where we can generate reports for multiple time periods. So that's kind of, just want to point that out because I thought it was well crafted and maybe not recognized as much as it ought to be. And so I thought I would point some attention to it. In any case, that's that.